Everyone wants to build a long-term wealth, but the biggest challenge is figuring out where to put your money so it grows steadily without taking unnecessary risks. That is where ETF or exchange traded funds come in. They give you instant diversification, low fees, and exposure to some of the strongest company in the world. And if you pick the right ones, you can literally buy them and hold them and let compounding do the work for decades. In this video, I'll break down my top 3 ETF to buy now for long-term wealth. These are not short-term trading play. They are investments I believe can carry you through 2025, 2030 and beyond. I'll explain what each ETF holds, why it's powerful and how I personally think about using them in my portfolio. So now let's get started. Before I jump into the list, let's quickly talk about why ETF are one of the best tools for long-term investor. Number 1, diversification. Instead of betting on one company, ETF give you exposure to a dozen or even thousands of stocks at once. That spreads your risk. Number 2, low risk. Most ETF charge expense ratio as low as 0.03%. That means almost all your money is working for you instead of going to fees. Number 3, liquidity and simplicity. ETF trades like stocks, so they are easy to buy and sell. And you don't have to research 100 different companies individually, you just buy the basket. The last one, compounding power. If you reinvest dividends and keep adding over time, you are harvesting one of the stronger forces in investing, compound growth. Now with that foundation, let's dive into my top 3 ETF. My first pick is Vanguard S&P 500 ETF, ticker symbol VOO. VOO is the simplest, most reliable ETF you can buy if you want long-term exposure to the US economy. This ETF tracks the S&P 500 index, which represent the 500 largest public traded companies in America. Think of names like Apple, Microsoft, Amazon, Tesla, and Nvidia, all included in this ETF. Together, these companies make around 80% of the US stock market value. Why I like it? They have proven track record. Over the long run, the S&P 500 has returned around 10% per year on average. That means if you invest 10,000 and leave it alone, historical it could grow to over 170,000 in 30 years. VOO have a fees of 0.03 annual. For every 10,000 investors, there's only $3 a year in fees. Compare that to an active managed fund that charge 1% or more. Resilience through crisis. From dot-com bubble to 2008 financial crash and the 2020 pandemic, the S&P 500 always recover and reach new highs. If you put 1,000 into the S&P 500 in 1990, today it will be worth more than $20,000 without you doing anything. And that is the power of holding VOO long term. If you are looking for a broker to start investing, check out Tiger Broker Singapore. They are user friendly, offer responsive customer service, and make the trading journey much smoother, especially if you are just getting started. And here's a bonus. If you use my referral link and deposit at least 1000 USD and complete just one buy trade, you'll receive USD $5 worth of Tesla stock. This is a brokerage that have simple steps, quick rewards, and a great platform. You will find my referral link in the description below. Feel free to check it out. Tiger Broker is currently running a SG60 campaign with SGX. Enjoy no custodian fees, zero commission for SGX listed securities. SGX CDP custodian fees for Tiger Broker is waived until further notice. No additional action required. This is a 3 months campaign, 23rd of July to 17th October, designed to reward both consistent trader and top performer. Trade SGX listed security during the campaign period to climb the leaderboard and their prices worth SG60 to SG 3800. My second pick will be QQQ Trust, ticker symbol QQQ. QQQ tracks the Nasdaq 100, which include 100 of the largest non-financial companies listed on the Nasdaq. That means you are getting massive exposure to tech giants like Apple, Microsoft, Nvidia, Amazon, and Google, as well as growth leader in sector like biotech, semiconductor, and cloud computing. Why I like QQQ? They have a tech growth as technology is the driving force of the modern economy, and QQQ gives you the concentrated exposure to this sector. Second, innovation exposure. You are not just buying today's winner. You are also buying companies leading in AI, cloud, and clean energy. Over the past 10 years, QQQ has dramatically outperformed the S&P 500 thanks to the strength of tech. Even though QQQ is more volatile than VOO because tech stock can swing harder during downturns. But over the long term, that volatility has historically translated into a higher return. If you invest 10,000 in QQQ just 10 years ago, and today you will be well over 50,000. And that is the power of tech growth. My third pick will be the Vanguard Dividend Appreciative ETF, ticker symbol VIG. This ETF focuses on US company that has consistently increased their dividends for at least 10 years in a row. These are companies with strong balance sheet, steady cash flow, and shareholder-friendly management. Why dividend growth matter? Companies that rise dividends year after year tend to be financially healthy. Dividends provide income you can reinvest, which accelerate compounding. During market downturns, dividend-paying stock often hold up better than non-dividend ones. So what is inside VIG? You will find companies like Johnson& and Johnson, Microsoft, Pepsi, and household names with long historical rewarding shareholder. Let's say you invest 1000 in VIG and reinvest all the dividends. Even if the share price goes nowhere for a few years, your position is still growing thanks to the dividend reinvestments. Over decades, this snowball effect becomes massive. So why these three together works? So why not just hold one ETF? Why combine these three? Because together they give you the perfect balance. VOO is for broad market exposure and the backbone of US economy. QQQ will have innovation, technology and growth. VIG will have stability, income and dividend growth. Think of it like a meal. VOO will be your main dish. QQQ will be your side meal that add extra excitement. And VIG is the balance that keep everything steady. With these three, you will be covered whether the market is blooming or facing volatility. So how will I be personally investing in this ETF? Number one, I'll be dollar cost averaging. I'll invest a fixed amount every month, no matter if the market is up or down. Over time, this smooth out volatility. Reinvest dividends. Every dividends paid get reinvested into buying more shares, and that is how compounding accelerates. Think of it as a long-term plan. These are not quick flip trades. They are designed to build serious wealth over decades. Remember, the market will crash, it will have correction. It will scare you, but if you can ignore the noise and stay consistent, this ETF will do the heavy lifting for you. So to recap, my top 3 ETF for long-term wealth are VOO, the S&P 500 backbone, QQQ, the innovation and growth engine, and VIG, the stability and dividend growth. With these three, you are not just investing, you are building a resilient portfolio that can weather downturns, grow during blow, and compound your wealth over decades. If you find this video helpful, don't forget to hit the like button, subscribe, and turn on the notification. And now I want to hear from you. Which one of these ETF would you buy first? VOO, QQQ, or VIG? Let me know in the comments below.